Happy Hump Day, everybody. It's Wednesday here in Brooklyn, New York. We're living the stream, and welcome to Talkenomics Live. I'm Adam Shapiro. We got a lot to talk about, and before I introduce the guests, my co-pilot tonight and then our first guest, I just want to let you know that the Canadian wildfires, the smoke has hit New York City, and it is, you can't really see it too much, but you can feel it, you can breathe it. It's in the back of your throat, and it's nasty. And I was thinking, here's the trivia question. Why is Kimberly Wilkins, also known as Sweet Brown, important on a day like today in New York City? Well, you have to be at least 20 years old to know this one. And the reason is there was that great hit song based on something she said because she had bronchitis. Ain't nobody got time for that. That was Kimberly Wilkins. And when you think about the Canadian wildfires, ain't nobody got time for that. Which is, although we have slugged tonight's episode, tariffs, taxes, and tickers, ain't nobody got time for that because we're going to be asking our guests. There was a lot of doom and gloom when we were talking about the tariffs and Liberation Day, and we all felt some of the gloom. And yet, if you've looked at your portfolio, if you've played this right, you're probably not only recovered, but you might even be higher than you were on, what did they call it, Liberation Day. So with that, let's bring in my co-pilot tonight, our returning champion, David Nelson. He is the chief strategist at Belpointe, and we appreciate you being here as always. He's also the host of The Money Runner. He's got his own podcast, his own weekly newsletter that you can get on Substack. So, David, it's always good to see you, and I want to ask you real quick.
Sure.
Where are we in this cycle? Because this is why people pay you and not me.
Yeah, we've come a long way since Liberation Day. We had a quick move down. We were probably down about almost 15% at the lows. And it was an extraordinary comeback. And as we learned over the last month, you know, we've always lived in fear that we were one tweet away from the market being down 1,000 points. But what we learned in the last couple of months, we're also one tweet away from the market being up 1,000 points. And that's maybe the lesson learned in the last couple of months. Maybe put the rhetoric aside and focus on the knitting, focus on the companies, focus on the earnings, and try to put a lot of the politics outside of your portfolio.
All right. Well, David's going to be my co-pilot for the next hour. And our first guest, David's going to help me get some insight out of this individual. They always say you don't need an introduction because you've seen David on CNBC, Fox Business, Yahoo Finance. You've seen our next guest on CNBC, Fox Business, Bloomberg, Yahoo Finance, the usual culprits, and that is Thomas Hayes, the founder and you're not only the founder, but you're the manager over at Great Hill Capital. So it's good to have you here, Thomas. It's good to see you. I haven't spoken with you since my days at Yahoo Finance and Fox Business. So thank you for doing this. And I got to ask you, where do you see us in the cycle right now? Because a lot of people were saying, you know, it's all over, jump off the cliff. And boy, were they wrong.
Yeah, no question about it. I'll tell you. And you had hedge funds record sellers at the exact wrong time in early April, right? The day before Trump put out, now's a good time to buy stocks. You had them selling a record $1 trillion in equities. So they're trapped. You got a lot of trapped bears that the market's taken off. And actually, intraday peak to trough was just around 20%. So you have these guys that didn't believe it on the way up, then were praying for a retest that never came. So every bit of decent news, you have forced buyers. Okay, they first you had the shorts that we're covering, then you have now forced people really looking to save their jobs. I mean, they sold at the bottom and now they've missed the recovery, so they're underperforming and they're going to have to buy up. Then you take earnings growth, which came in at 13.3% for the first quarter, which was about double expectations. We're going into the second quarter earnings season expecting 5% earnings growth. You look at Atlanta GDP now, which you take with a grain of salt, but it's looking like a recovery after a negative quarter of GDP. We're not going to get 2 consecutive quarters in a row because Atlanta GDP is looking at 4.6%. So even if they're half wrong, you're still over 2%, which means no 2 consecutive quarters of negative GDP. So, you know, you take the forced buyers, the trap bears, everyone was negative. You take decent earnings, you take decent Atlanta GDP, and then you offset it. Talk about crosswinds, Adam. And David, is you've got the ADP numbers were a little weak this morning, so that's kind of going to put a little pressure on the Fed. And the big number is coming out on Friday, with the non-farms payroll, and inflation has been low. So I will end it with Trump saying too late Powell may prove, in fact, to be correct.
That was okay. Before I let David jump in here, just a couple of things. I did some housekeeping. I've got two powerhouses here who understand these markets far better than me. So you should be asking the questions. I know you're watching on X right now because we have the count. All you got to do is put in your comment in the chat, and I'll make sure that either Thomas and or David answers the question you have about where we're headed. And what Thomas just said about too late Powell, that was President Trump's Truth Social post this morning about ADP. David, I'm going to throw this to you with this question. The ADP number, and I assigned this to my staff, they're writing this story overnight for tomorrow. The ADP number always diverges from the reality of the labor number that we're going to get on the non-farm payroll number on Friday. So is ADP even worth? I mean, we clutch the pearls, Sturm and Drang, with the ADP report, but is it worth anything?
There's almost no correlation between the two. You pointed it out correctly. There's been a lot of months where ADP had a very weak number, and then we have a blockbuster number on the following Friday, and vice versa. It's been exactly opposite, at other times. I'm not sure which is worse, the ADP numbers or the BLS numbers, because often it's not really indicative of what's really happening in the real economy. So I didn't pay any attention to ADP this morning.
Thomas?
Well, look, I think you gotta pay attention to the trends, and if you see a really weak number, even if the number comes in strong-ish on Friday, expectations are pretty low on Friday. 130,000 down from 177,000. So all of this opens the possibility for the Fed to save face. There's very low expectations of a cut in June, and that could be the surprise. 78% chance of a cut in September, so that wouldn't be a surprise. I guess the market short term is paying an awful lot of attention to this. I guess to some degree, the Apple Developers Conference to see if they can get their AI stuff together, because that's a big weighting in the S&P, but much less important than how it's going to impact. And if you look at the beige book that came out, demand for labor is slowing. So you're seeing it, look through ADP and start to look at the beige book and what businesses are saying and doing, less hours. That could move the Fed's hand and enable Powell at the same time to save face, not look like he's pressured by Trump. But, to say that you're data dependent and being 150, 175 basis points too restrictive because you are predicting tariffs will raise prices when it simply wasn't the case in 2018 is not data dependent. They are prediction dependent, and they are predicting that any tariffs will create a short-term bump in inflation. Otherwise, they would acknowledge they're 150 to 175 basis points too restrictive. And I'm not saying this as an asset owner. I'm saying this, you've got the bulk of our population trying to start a life and trying to buy a house and simply can't do it at 7.25 interest rates, record high prices. And Besson's got a couple arrows in his quiver to deal with mortgage rates with the SLR, bringing down capital requirements for banks this summer. Maybe the Genius Act will create some demand for treasuries as well, bring yields down and enable mortgage rates to get down below 6% before the end of the year. And that would reignite housing and all ancillary businesses. But that's where we are. And I think too late Powell is a risk. Hopefully the jobs report will give him cover to act sooner rather than later.
David, jump in here with a question.
I'm going to be on the other side. I'm going to be on the other side of this. I think we're worried about the wrong end of the yield curve. Powell, there's not a lot Powell is going to be able to do for housing. The only thing that's going to happen for housing, if you get 10-year yields down, and to do that, you're going to have to get some kind of fiscal sense that we're starting to get our debt and deficits under control. Right now, investors in U.S. Treasuries are looking at an interest rate. The juice on our debt right now, it's literally straight up. Straight up, it is parabolic. And as long as that exists, anybody that's going to want to invest on the long end of their curve, they're going to want some food on their plate. The auctions will always happen, and we'll be able to sell our treasuries. But the question is, what price? And at some point in time, you're going to be having a conversation not about 5, but about 6.
Yeah, well, look, to the point I made about what Besson said with the SLR, mortgage rates are contingent upon the longer end of the curve, the 10-year. And what he specifically said is by removing the capital requirements and exempting treasuries, what you'll see is 30 to 60 basis points lower in the U.S. 10-year treasury yield. So he's handling it on that front. Whether the stablecoin demand for additional treasuries will be helpful or not is immaterial. But I'll tell you what will be helpful on the long end of the curve is if you continue to see weakness in the labor market, and we're going to find out if that's the case on Friday. But I will say that while mortgage rates are contingent on the 10-year yield, don't forget that you have the HELOC game, you have the 5-year ARM game that is more dependent on the shorter end, and to get people into the housing rate, into the housing market on interest onlys. That's the short end of the curve. So Powell can do something about affordability, and instead he's taken the starter home buyers from age 33 to age 38, 39, 40, 41, and delaying a lot of people's lives, which unnecessarily, when you look at the inflation numbers, came in 2.1%. PCE price index on Friday, and he's justifying a 4.25 Fed funds rate. Makes no sense.
And it should be a buyer's market in the housing market right now, because there's a ton, except in places like Miami, there's a ton of housing now that is on the market waiting for those buyers. Someone mentioned the word debt. That was David. So let's get to the debt issue, because I saw on Truth Social today something that just made me laugh. I've interviewed Elizabeth Warren. I've interviewed President Trump back years ago, and those two agree. They agree that it's time to eliminate the borrowing cap, the debt cap in Congress, and just have unlimited borrowing power. What do you think, David?
I would eliminate the cap. It's a meaningless exercise. We bump up against this and we go through the wranglings of it, a couple of times a year sometimes. And it's meaningless. We've already approved this spending. This spending was already passed by Congress. Having it in there as an arbitrary stopping point, it's nice to think that it's a cap. It's not a cap. Has it ever worked? We've had a cap for the last decade, and it hasn't done anything. So I would say push it aside. On that front, I guess I'm on the same side as Elizabeth and Donald.
Thomas, would you get rid of the cap?
Yeah, look, at the end of the day, we need a little bit of what people are missing here is we're not getting out of this 120% debt to GDP by austerity. Okay, that's not what's going to happen. And what Powell's missing here is austerity is going to create a bigger debt problem and create a lot of defaults. What happened the last time we were in this situation post World War II, 120% debt to GDP? What did they do? You had growth, and you had above trend inflation from 1948 to basically 1958. Debt to GDP came down from 120% down to 63%. And you did that with a little bit above trend, 3 to 5% inflation. You did that with lower rates. And you let the economy run super hot. And with the deregulation that this administration has on its plate, the tax cuts that they're proposing, and by the way, it's interesting when you actually go through the thousands pages of the big, beautiful bill versus what the CBO and the media is reporting about the bill, the math is that the overall federal budget baseline is smaller than the current budget when you subtract everything the bill unfunds from what remains. Okay, so throw it, if you don't have 3 days to read 1,000 pages, throw it into 3 different AI models and they'll come out with that result. And the one that doesn't, Anthropic, that comes up with all the negative headlines about the bill, acknowledges, if you dig deeper, that they are drawing their conclusions on the basis of media headlines versus the text document itself. And when you force it to go back to the text document, it comes up to a similar conclusion, which is the baseline is smaller than the current budget when you back out everything the bill unfunds from what remains. So, very few people read the 1,000-page bill, and that's why the negative headlines can continue to fly, because it's easy.
We know that Marjorie Taylor Greene didn't read it. She admitted that. But hey, real quick, just want to remind everybody, we're getting this data, this information from David and Thomas for free. David, again, has his podcast and his newsletter, The Money Runner. Thomas has Hedge Fund Tips with Tom Hayes, and you can check this out at his website. And I believe you have Where the Money is Going. But I want to find out where Elon Musk is going, because Elon Musk, talk about biting the hand that fed you. And I realized he fed the Trump administration, or at least the campaign, hundreds of millions in donations. But Musk is coming out against BBB, the big beautiful bill, the tax bill. We're talking about debt, and he's calling it a calamity. I think the CBO came out with its score that it'll add 2.4 trillion to to the national debt over the next 10 years. And the reason I bring this up is, how does this land? How do you get Republicans to line up and pass this thing if you've got Elon Musk saying, don't go there? Thomas?
Yeah, look, Elon's one of the most brilliant entrepreneurs and creators in our lifetime. He's the Thomas Edison of our day. He's a genius, all of that stuff, okay? The fact of the matter is, he's also been out on Twitter at certain times in the stock market and called for a huge crash that never came, and record highs. I mean, just because someone's brilliant and a billionaire doesn't mean they're brilliant at everything that they do. I'm good at one thing, picking stocks. If you ask me about Bitcoin and I offer an opinion, well, shame on you for listening to me. That's not what I do. That's not in my lane. Now, that said, he's got a tremendous amount of experience, having headed Doge for 130 days and cutting $175 billion of cost, $1.5 billion a day. At that pace, they could cut $1 trillion within a year and a half. They've taken the ex-Doge employees and made political appointments in every agent. So the headline that it's going to be part of the DNA of government under this administration is not fluff. It's true. And I think they will actually fulfill on a lot more cuts than advertised or than is expected. So he has a lot of heft when he says that. I don't think he has 1,000 hours to read it, but I can guarantee you if he fed it into Grok, which is probably one of the best AI models, which is his model, he'd come to slightly different conclusions. At the end of the day, it's got to get passed, okay? And we're not gonna balance it on a mathematical equation. The only way we're gonna have a possibility of balancing it is if this economy runs hot as hell. And the only way they're gonna run this economy hot as hell is growth-led strategies, massive deregulation, bringing down the capital requirements for banks, increasing lending, bringing down rates, and hoping for the best. Look, there is a faith that inflation doesn't get out of control. And the recency bias of the last 3 years is, oh, watch out for inflation. But that was a one-time, supply shock that we had because the world shut down for 2 years, and people keep extrapolating with recency bias that because it happened during a once-in-a-100-year event, it's guaranteed to happen. And then you've got the Arthur Burns nonsense from the 1970s, which is a completely apples to orange comparison. As they say in Texas, that old dog don't hunt. So I would suggest that we look at history clearly and look past the 70s and look to the 50s, the last time we were in this situation, 120% debt to GDP, and follow that playbook, which I do think the administration minus Powell is attempting to do, and we're going to be just fine. What
do you think, David?
I think, the truth doesn't live on the extremes, and we have two extremes here. Yes, the growth will solve a lot of problems, but there's a balance here. And if you go back to World War II, post-World War II, and the growth that we had after that, you got to remember where the entitlements were at that time. When FDR came up with Social Security, the average life expectancy was 57 years old. No one was going to collect. Today, it's a different equation, and it's growing exponentially. As for Elon Musk, I think what frustrates Elon is the legislative process. And he's a CEO. He's used to coming into a company, seeing the problems, identifying them, and fixing them quickly. Unfortunately, Congress doesn't work that way because politicians have competing priorities. Fixing the country, that's second on their list. The first thing is bring home the bacon and bring what they need to do to get reelected. And that means bringing home legislative priorities that either bring projects to their district or protect themselves in the case of Medicaid. I can understand why Lisa Murkowski, Susan Collins, and those, they're never going to embrace anything in the Medicaid cuts because the Democrats are going to use it against them, and they're vulnerable. And that's the problem with the legislative process, and it's why we end up with these big, giant bills that are nothing more than a big, giant compromise. But I agree. The only solution here is we got to get the bill through.
So let me ask the two of you my favorite question these days. Imagine you're 25 years old and you have $10,000 and you have to invest it. David first, How would you allocate that? Given everything we're now facing, where would you put that money to work?
Well, if you're 25 years old, you're totally risk on. There's no such thing as a balanced portfolio. You don't put it in treasuries. You're gonna look at where the secular trend is at the moment, and that's clearly AI. That's the bright spot of this economy. Is clearly the biggest technology shift in my lifetime. It will be the driver of capital investment for the next 10, maybe 20 years. So that's where you would put your money right now. And you would just put it in there. You would forget about it. You'd forget the volatility and just hang on.
Thomas?
All right, I take a different side. I think they're going to bring down the longer end of the curve as advertised. I think that's going to be really exceptionally good for housing. Now, look, Adam, they call me turnaround Tom for a reason. I'm always buying things that are out of favor and waiting for them to recover. So what's dramatically out of favor as a function of rates being high is housing and housing related businesses. So I don't want to deal with the warring factions. I don't want to buy DR Horton. I don't want to buy Pulte, but I do want to buy the building suppliers like QXO, which Brad Jacobs is running as a roll-up. He put $900 million of his own money. He did that in XPO Logistics in 2011. You basically made, many bags, like 69, 79 times your money over a period of 10 years. He did United Rentals, the equipment leasing in the late 90s. You basically made over 50 times your money if you had invested with him over 15 years. And he's doing a new one, and he's put a lot of his own money in it. He started with Beacon Roofing. Does a lot of commercial roofing. If your roof leaks, it's not a, should we get the pink one or the blue one? Should we, shouldn't we? It's like, fix my roof. I want the water out of my living room. And that's a great business. He paid 10 times EBITDA, but he'll do what he always does, is bring in technology. He'll double EBITDA over the next few years, and we'll be off to the races. He expects, as usual, it's an $800 billion business. He'll roll up about $50 to $80 billion top line with double-digit EBITDA margins, which effectively means your $16 stock will be $70, $80, $90, $100, probably 5, 6, 7 years out. So AI or not, I don't think you're going to get too many 5 to 7 baggers over the next handful of years with a proven winner who constantly makes money for his shareholders. And then if you want more subdued things, doubles and triples in the next few years, you buy something like a Generac, which is tied to housing and interest rates, leader in home standby generators. It sounds silly, but with power outages going up, with data center backups on the commercial side, and with home building, which is going to boom again with this administration, by the way, because they're going to open up about 500. It would take about 512,000 acres of public land of the tens of millions in order to get 3-4 million new starter homes. So, some of the areas are actually in rural, but actually quite a few of the federally owned lands are, as people don't know, in metropolitan areas. So they're going to open up the federal lands. Bessent's going to change the capital requirements at banks to create a tremendous amount of demand for treasuries. Maybe you get the Genius Act legislation. And if you're Gen Z, you realize that the biggest portion of the population is the millennials, 72 millennials. They're in their mid-30s. They want to buy houses. They just can't. We need to build a bunch of 1,500 square foot houses. Think Levittown post-World War II versus not everyone needs a 4,500 square foot starter home with an indoor pool, which is what the supply is in the market right now. So they need to rectify that imbalance. The administration knows this. They are taking the actions to do so. So I would play that theme. I'm not discounting AI. AI is going to be an unbelievable secular theme. So you're going to want to have some exposure. Question is how, but I think in terms of the next 3 years, doubling and tripling, there's a lot of opportunity because some of these stocks are down 70, 80%, and the businesses are throwing off record free cash flow.
I just did an interview with an analyst at my other job. And we were talking about, because of AI, demand for electricity and where the investment opportunities are with grid build. Some people, you saw the Meta deal yesterday with nuclear, but what this individual was saying was nat gas. Listen, everyone stand by. We're going to take a quick break. And when we come back, we're going to talk about Apple. And welcome back to Talkenomics Live. Remember, you can ask our guests the questions you want to hear from people who are in the know. All you got to do is put your comment, your question into the Twitter chat or into the YouTube chat, and we'll make sure that we direct that question to the appropriate person. You've already met David Nelson. Let's bring into the program, to the live stream, Francis Newton Stacy. It's good to see you again. And we're going to be talking a great deal about, I want to hit Apple. I know we're not going to talk specifically about stocks, but from an AI context. But I want to find out about the Global Economic Sustainable Development Commission and the role that you are working on there. What is that about? Is that ESG or is that something even greater than that?
It's not really ESG. It's interesting, actually, with all of these committees because, they've pivoted significantly since Trump got into office. But basically, what we're doing is we're kind of a think tank around global digital currencies and impact finance around the world. And we have these big conversations with governments. Our committee is sponsored by El Salvador. So obviously, they've adopted Bitcoin. And there hasn't been a lot going on with it just recently, but I'm sure it will ramp back up again, particularly with discussions around this bond market, the debt ceilings. But it's a think tank that kind of offers commentary and solutions around those sort of things, basically.
So I'm going to broaden this out. I want to talk about AI in the context of Apple and the Worldwide Developers Conference that's coming up, and then I want to come back to crypto because I've had specific questions about that. But and I'll start again with Francis on this first question regarding Apple and WWDC. Do you think we're going to hear anything earth-shattering from them? Because they're AI, and I've got the iPhone, I got the MacBook, and I'm going to tell you personally, big disappointment, Apple. Love the products, but AI, ain't nobody got time for that.
Yeah, I use AI. I'm limited in my use of AI. I'm limited in my tech. I'm such a nerd. I'm like a fiat historian. But anyway, I am an Apple loyalist. I have all of their products. I use all of their products. I love the user-friendly aspect of it. As far as can they keep up with all the innovation, they haven't actually for a while. If you really think about it, the iPhone hasn't changed. Wasn't it one of Powell's relatives that Jobs' relatives that tweeted at some point, like, what are you going to do new with the iPhone? What's happening with the iPhone? So right. Hard to say with Apple. Generally speaking, when you're talking about tech, you're talking about companies like Apple. They've become old faithful because they have massive cash on their balance sheets. They're not overly indebted. And so that's the thing that's become, sort of really attractive since COVID about tech stocks in general.
David?
I'm going to go out on a limb here and say the emperor has no clothes. This is very reminiscent of other gargantuan companies, IBM in the 80s, Cisco in 2000. Apple's a wonderful company. It's a cash flow machine, but they played it safe. And like everything else in life, watch your favorite football team and they go into that prevent defense. And they lose the game in the fourth quarter because everybody else marches down the field. And that's what's happened to Apple. That thrill that I used to get when I go into an Apple store and you get that little box, you open it up, it's gone. Because I know what's in that box is very little different than what I bought back in 2014. There's really hasn't been a lot of innovation in that sense. So it's big. It's certainly not going anywhere. They can expand in other areas like services, but even there, they're going to have to probably give up that 30% fee that they get from their app developers. Mm-hmm. And I think at some point, investors are going to demand that Tim Cook step down and move on to. They need a vision. They need somebody with a vision, and they've taken the products that Steve Jobs invented, so many years ago. Everything else since then has been, an offshoot of that. The watch, the iPad, all of these things all go back to the iPhone. He's a great operator. He's expanded the company. It's a $3 trillion company, or at least it was. But I think the time is now to move on. They need a bigger vision.
Francis, I want to shift this to, because AI, and I work in the AI space 9 to 5. What I don't get well is crypto and Bitcoin and the different digital currencies. I'm one of the skeptics who says what does Bitcoin, other than as a store of value, what does it solve? What issue does it solve for that didn't exist, that wasn't being solved for, as you said earlier, with fiat currency? So do you want to dive into that? Because I am still, my brother's making a bundle with Bitcoin, but I am not, and I don't understand it.
Yeah. No, back into my world from Techland. Okay, good. Yeah, so structurally, this is so interesting. I attended the 75th anniversary of Bretton Woods. I think it was in 19. And it was a total it was all the Bitcoiners, like the famous ones were invited, and central bankers and monetarists were invited. And it was this kind of get together. And I'll never forget listening to a debate between a gold bug, a couple of Bitcoiners, and a traditional fiat central bank, historian, basically. And it was the most fascinating debate. The thing about, if you think about Uber, they were able to disrupt what taxis do because Uber totally understood what taxis do. What's happening with Bitcoin is it was brought forward, and crypto was brought forward to try and disrupt fiat. But I have yet to meet anybody who's a Bitcoin enthusiast who actually understands what the actual role of fiat is and how it accomplishes it. And so Bitcoin doesn't yet have that. Now, there was some confusion back in the day because you had fiat that was backed by gold. So you had quote unquote intrinsic value. Obviously in 1971, Nixon took us off the gold standard. And since then, we've just had pure fiat. Structurally, Bitcoin and fiat are very different. Fiat is elastic because fiat's based on debt. So when the debt is outstanding, it is part of the M2 money stock. When the debt comes in, when you pay off your debt, or when debt is written off in some kind of a credit crisis, then it comes off the M2 money stock. Bitcoin, like gold before they attached it to fiat, has a certain supply. So it's not elastic. And this is an ages-old debate between Jefferson and Hamilton, and even before that, in amongst European countries. But the thing is that should you monetize currency through debt? Well, debt's elastic. If you had no debt and you monetized through no debt, okay, which was kind of the idea behind Bitcoin and decentralizing finance and all of that, inflation could be rampant because there's no way to take the currency back out of the system. And when you look at what the central banks do, there are two things, monetary and fiscal policy. And when you look at what they do is the central bank is able to expand the money supply, but more importantly, it's able to contract the money supply. And that's what they do with interest rates and obviously tightening the balance sheet in order to ameliorate or control the ratio between the amount of money in the system and the goods and services. And it's just as simple as, and I don't know how technical our audience is, but it's just as simple as, look, if you have $10 in circulation and 10 loaves of bread, you can say, okay, that would be $1 a loaf. If you have $20 in circulation and 10 loaves of bread, that's $2 a loaf. If you have $5 in circulation and 10 loaves of bread, that's 50 cents a loaf, right? So there's a ratio between the amount of money and the goods and services, and that ratio has to be managed. And that is the mandate of the Fed. And so for Bitcoin to come in and technologically great, right? But for Bitcoin to come in and replace fiat, you would have to create a structure where you could also extinguish money off of the supply to manage the ratio between money and goods and services, which determines inflation and deflation.
I'm going to quote my favorite, statement of the evening. Ain't nobody got time for that. I mean, but at the end of the day, let David answer this question and then come back to you, Francis. When we're talking about crypto, I don't deny that fortunes are being made. I'm thinking of my brother right now. He better buy me a good birthday dinner in September. But what role, since we're not going to get off fiat anytime soon, and I understand what Francis was just saying about way to control inflation because Bitcoin would be a pure market-driven value asset. But what role, since we're not going to get off fiat, does Bitcoin serve other than the store of value?
I don't know if it is a store of value in that sense, because a store of value to me can't be this volatile. It is a speculative asset. I'll grant you that, and money has been made. And I've been a skeptic, and I missed the boat certainly early on. And I recognize that today it is an asset class. When you don't get this large, and you can't say that it's not an asset class. However, I would say that probably 99% of all people that own Bitcoin really don't know much about it, other than the fact that it goes up, and that's a little uncomfortable. And for me as an asset manager, it's uncomfortable for a lot of people out there. Yet they own it because they don't, that fear of missing out. And you've got to have it. And I, as a portfolio manager, have a small amount in it, not enough that it can hurt me, but not enough to get rich either. And that's the concerning factor of it for me, because the utility of it, some of the promises of it from blockchain, some of the things that were going to be used, we were promised years ago that on the NASDAQ, they were going to be clearing transactions using blockchain technology. I haven't seen any of that come to fruition at this point. So it's out there, it's a shiny thing, and everybody seems to be using it and making money on it.
Just so you know, though, Frances's background, she was the one who got out at the top just before 2008. So listen carefully. Bitcoin may be going up, but Frances, I don't hear you saying it's time to get out.
Well, here's the thing. So when I look at Bitcoin, this is my analysis, because I'm thinking in terms of economic seasons and global macro and the business cycle. And I would argue that the business cycle has changed in the timing factors. But just like, you can take an old Model T and you can look at a Tesla, and they are very different, but they still both have axles and wheels, right? So I think that the business cycle is an axles and wheels situation. And when I look at Bitcoin and whether to participate in Bitcoin, the most interesting thing to me is the correlation with the S&P 500. The entire time, this was so fascinating to me. So the entire time the S&P was going up before the tariff sell-off, Bitcoin was pretty much in lockstep with the S&P 500. Then what happened was it sold in lockstep with the S&P 500, but at a certain point, Bitcoin stopped going down and stabilized before the bottom of the S&P 500. So you can see the psychology changing. Now, what was very interesting was, gold was sort of, went bananas during the sell-off. And gold's been going bananas anyway because there's so much demand from central banks around the world. But it's just interesting because Bitcoin and gold are not correlated. So Bitcoin is more correlated with the S&P 500. And then what's occurred recently, obviously, we've come off of that low very strongly. Tech, your Mag 5 in this case instead of Mag 7. And then Bitcoin has resumed its bullish trend around that. So I think the story of Bitcoin is not this debate about intrinsic value. I think the story of Bitcoin is it correlated with the S&P 500? Is it correlated with the dollar? Is there a correlation or negative correlation with rates? And is it correlated with gold? And then you can kind of see the psychology behind the bullish trend around Bitcoin. And I assume that over the decades, these correlations will actually change.
Okay, if the correlations are going to change, that leads me perfectly to the next question, because this is something that I fear. And it's, again, I live under the rock. You two are the experts. Is the dollar doomed as the global reserve currency? David, you first on this one.
We're losing it for sure. We've taken it for granted. I think what Jamie Dimon said the other day is there's a lot of truth to what he said. BRICS, Brazil, Russia, India, China, South Africa, is a lot more countries right now. And increasingly around the world, we're seeing transactions in non-dollar currencies, even oil. So we're still the big boat out there. But if we continue on the fiscal path that we have without repairing it, and maybe like Thomas said, maybe we're going to grow our way out of this, and it's not going to be as serious. But until we do something about that, then it is an issue, because there's a lot of countries out there. Look at the list of those countries that are on there. Iran is on that list as well. China is on that list. We don't have a lot of friends on that list, and they have a lot at stake to pushing the dollar aside. So you're seeing transactions, especially in oil, starting to take place between member nations in local currency. And that should be concerning to all of us.
Frances?
Okay. Right now, other countries have more incentive than ever with this trade discussion and potential trade war to remove the leverage that the United States has to the best of their ability and ascertain their own leverage. Now, when we look at these trade wars, these countries, many of them, particularly in the BRICS, are suppliers. They are the supply. They are not the demand. The demand, 30% of the world's GDP is of the world's consumption is the United States. And so, because 30% of the world's consumption is the United States, it's very hard to replace that. So, they can all go do deals together. I mean, I know that when Trump brought out Liberation Day, Japan and China and South Korea were talking, but it's like they're all suppliers. So, who's going to absorb their product? Okay. So, then they go to where do they have leverage? And particularly China. Okay. So, what happened? We had Liberation Day. Oh, they also, foreign countries in aggregate, own 30% of treasuries. So 30% of our bond market, right? All along the curve. And so they started selling treasuries. And that is what made Trump back down. He had all of the leverage with consumerism, and them selling our treasuries caused rates to, go up, because obviously when you sell treasuries and price goes down, rates and yields go up. And that then starts to threaten our credit markets. And we are way over levered in every area of the economy. So that's the thing that caused Trump to back down. So it's this sort of cat and mouse game of leverage. Thus far, so countries in the background are trying to dump the US dollar. They're trying to dump the US dollar. But it's kind of a catch-22. But because we are the world's reserve currency, we have demand in the debt markets. Mm-hmm. If we were to lose status as the world's reserve currency, because
Katie barred the door.
Yeah, absolutely, right? Absolutely. There would be no more demand in the debt market. You would have to jack those yields up to, what they've done with other credit crises in other countries, where those yields just skyrocket. That's the only way to get anybody to buy the debt. So is it happening tomorrow? No. Is it headed in that direction? Yes. The remaining leverage that we have is the American consumerism, which is obviously based on credit. The thing that would undermine what Trump is trying to do, we saw what happened with this trade war, right? These Chinese, boats were out in the waters, sitting there just piled high with goods that they could do nothing with. Nobody could absorb them. The thing that's interesting that kind of gives us a little bit, pardon the pun, a trump card, is the fact that our central bankers can go in and buy our bonds. Their central bankers aren't going to buy their widgets, not to the degree that we would. And so that's kind of the leverage, and that's the last vestige of leverage that Trump has, and he's trying like hell to, push that leverage so that we don't lose the United States dollar as the world's reserve currency. Now, Dalio, we're all familiar with Ray Dalio. Ray Dalio is saying mechanically, and I respect him because he does the math. He can say what the mechanics are, again, axles and wheels. Nobody times it. There are too many variables in the system. But what he's basically saying is that if we don't get our deficit as a percentage of GDP down to 3.5%, we will fall off the proverbial debt curve. He has delineated many debt crises over the hundreds of years. And he's just arguing that the mechanics are the same. BRICS is counting on that. So if you look at the math behind the reciprocal tariffs on Liberation Day, and you take last year's trade numbers, when you look at that, it takes the tariff revenue up exactly to take us down to 3.5%, as a deficit, as a percentage of GDP. So you can see what was going on with the Trump administration. He was balked by the Treasury selling. So now he's got to overcome that. The other piece of leverage that China has is the minerals. We have minerals in this country, but we're not necessarily going to be able, just like our manufacturing base, we cannot rebuild it in 5 seconds. We're not going to be able to get the refining capabilities of those minerals tomorrow. That was the whole trip to Greenland, right? So Greenland's now done. I think I read somewhere a deal with the Dutch. But the point is that Trump probably right now has the most leverage. because nobody else consumes widgets to the point where we consume widgets. Trump has the catch-22 situation of we have to get obviously fiscal spending has been extremely high, and that filled in after the Fed started tightening the balance sheet, because the Fed was taking liquidity out of the system with rates and reducing the balance sheet. So the fiscal spending put liquidity back into the system. The M2 money supply is as high as it's ever been. That's heavily correlated with the S&P 500, heavily correlated with Bitcoin. And that's the precursor. But the thing that we run into is it's like, okay, get the fiscal spending under control, but what do we do to replace the liquidity? Because if you take too much liquidity out of the system too quickly, you're going to hit that proverbial threshold where you can't service the debt. A credit crisis is de facto deflationary. So this is the balance beam that he's trying to walk right now.
Okay. Yeah. So let me wrap this up now. I'm going to start with Francis, then I'm going to go to David. Final thoughts. Things feel pretty good right now. Should we trust the feeling, Francis?
Okay, so trust the feeling, right? Things happen very slowly and then all at once. Okay, this is what I'm watching to quote unquote trust the feeling. Number one, I expect the stock market to continue because the M2 money stock is up. I'm watching credit spreads to see if there are any credit situations, because the S&P is always going to follow the M2 money supply unless there's a credit situation. And even when we had the tariff sell-off in the S&P 500, the M2 and the S&P departed temporarily. And I said, wait, they're going to remarry each other because of the axles and wheels. Mm-hmm. And either the M2 is going to come down and marry the S&P 500, or the S&P 500 is going to go back up and marry the M2. The S&P 500 went back up and married the M2. Watching credit spreads, because credit spreads, if we have a credit situation, can change the M2 dynamics very dramatically and very drastically, like it did in the financial crisis, particularly with the amount of leverage we have in the system. Watching the yields. Some people think yields don't matter. Yields are the predicate of everything. And also, so yields, credit spreads, M2, S&P, technical support and resistance. But right now we're fine unless that sort of something gets triggered in the system that causes a credit event.
David?
I'll follow on that. The credit cycle is a big part of that, and that's why Trump pulled back. I would agree with that. Scott Bessent got to Trump and said, look, sir, the financial plumbing is coming undone. You saw yields rising and the dollar falling, a little unusual. That started to spook the markets. I would say ignore the S&P 500. We're too focused on it. I look inside the S&P 500 and the disparity is enormous. I look on a screen of 200 stocks. I'm going to see stocks that are up 15% to up 60%. I'm going to see stocks down 15 to 60%. It's that disparate at this point. We're too focused on the Mag 7 because you can't paint them all with the same brush. For every NVIDIA, there's an Apple. They're not all great. They're not all great investments at this point. Yet underneath the surface, I still stand by what I said earlier. We're in the middle or the early stages of the biggest technology shift in a lifetime. And it's going to drive capital investment for at least the next decade.
All right. I want to thank our guests tonight, Francis Newton, Stacy, all the best to you and the folks at Scarlet Oak Financial Services. And David Nelson, it is always good to see you. By the way, David was my first guest on Talkenomics, and we were bashing Apple back then. So David is the chief strategist at Belpointe Asset Management. It's always good to see you, both of you. Thank you very much.
Take care.
Now, before I go, we're going to do one of my what I call my talk. And I'm going to throw some numbers at you. And just so you know where I'm coming from, there are two issues that I care about in this world as I get older: literacy and hunger. That's it. That's where my donations go. But the other issue that a lot of people care about is healthcare. And we're watching as they debate the big, beautiful bill and the tax cuts, and we talk about the debts and the spending and what's going to happen to Medicaid. Let me throw some healthcare numbers out at you and then propose something which may sound preposterous, but when you add it up, why not? Here we go. According to the Kaiser Family Foundation, total spending for healthcare last year in the United States was $4.5 trillion. $4.5 trillion. Now here are the big, bills that we're talking about. Medicare cost us $148 billion. Medicaid this year is going to cost us $723 billion. Private citizens and private companies with healthcare spent $1.6 trillion for your insurance last year. So if you have healthcare insurance from your employer, or whether you're like me and you pay for it out of your own pocket because you're an LLC, 1.6 trillion. And then out-of-pocket costs, according to KKF, Kaiser Family Foundation, was 500 billion. So when you add that up, that's roughly 3.6 trillion. So we're off by about $900 billion. What's the deal here? Why can't Congress figure this out? There were proposals in the 70s and 80s. Some people think it was the Congressman Jack Kemp from Buffalo. Others say it was Senator Bob Dole. Neither of them actually proposed this. But it's circulated out there. And it's talking about a single payer, not health care, but health insurance. Look, federal employees are covered by the Federal Employees Health Benefits Program. And in the 80s, and I haven't been able to find out which Republican candidate it was who was proposing this, but said, look, just move everybody under the Federal Employees Health Benefits Program. If it's good enough for Congress, if it's good enough for the people who serve all of us by serving in the bureaucracy of the federal government, why not make that accessible for all Americans? And if we're already spending that amount of money, and there's a $900 billion gap, there's got to be a way to close it. And wouldn't the efficiencies of having that kind of insurance program, I'm not talking national health care, I'm talking about insurance. You could let people, if you want to buy out of it, buy health insurance through Aetna or whoever you want to go to. But the efficiencies you could create, wouldn't that help close the $900 billion gap? So that's what I'm proposing out there. We're spending $4.5 trillion a year on healthcare. And if you look at where the money is going, there's got to be a better way to do this. Because as someone who has to buy their own healthcare, I'm telling you, the Yiddish word fakakta, which means what it sounds like, that's the only way to describe our insurance program. We'll see you next week here on Talkenomics.